You know, in the world of business, we love to hear stories about explosive growth, right? The companies that catch lightning in a bottle. But honestly, the really remarkable stories, they're about survival. They're about innovation when your back is against the wall. This is one of those stories.
So let me just ask you this to set the scene. Imagine it's 1981. The economy is getting hammered by something called stagflation. And you decide that right now is the perfect time to start a housing company, with mortgage rates hitting an unbelievable 18%. I mean, who in their right mind would do that?
Well, you can probably guess that most companies born in that fire would have been toast. But one company, USA Properties Fund, founded by J.B. Brown, didn't just survive, it was literally forged by that economic chaos. And this is the story of how they pulled it off.
To really get this company, you have to understand the pressure that created it. The early 80s weren't just a little tough, they were like a filter. Only the most disciplined, financially conservative, and truly mission-driven companies had any chance of making it through.
This right here, this is basically the company's origin story. It's DNA. It all starts in '81 with J.B. Brown's big idea to build communities, not just apartment buildings. Then boom, 1986, a total game changer, a new federal program they jumped on. By '89, his son, Joffrey Brown, comes on board with a crucial banking background. And by '97, he's the one in the driver's seat ready to take the company to the next level.
Okay, so what was that game changer back in '86? Well, it became the financial engine of the whole company, the tool that let them build when almost nobody else could get funding. Let's break it down.
It's called the Low-Income Housing Tax Credit, or LIHTC for short. And put simply, it's a deal from the government. It gives investors this huge incentive, a dollar-for-dollar cut in their tax bill if they invest in building affordable housing. Now, a lot of builders saw this as just a bunch of red tape, but here's the key. USA Properties saw it as a stable, predictable way to grow in a totally unpredictable world. And what's so cool is how clean this system works. Okay, step one, USA Properties sells these tax credits to big investors to get cash for a project. Step two, with that cash in hand, they don't have to borrow nearly as much from the bank, which slashes their debt. And that leads to step three. Because their costs are lower, they can turn around and offer stable, affordable rents to the families and seniors who need it the most. It's a win-win-win.
And this funding model let them become a completely different kind of builder. See, most were merchant builders. They build fast, sell fast, and take the profit. USA Properties did the opposite. They had a long-term hold strategy. They were building for keeps. And to do that right, they brought everything in-house: development, construction, management. It just ensured higher quality, because hey, they had to live with their own buildings for decades. This also gave them the freedom to innovate, like creating their Vintage brand, which was a pioneer in creating communities where seniors could age in place.
So they built this really strong, disciplined company all through the '80s and '90s. But then came the ultimate stress test for anyone in the housing business, the 2008 global financial crisis. Just look at this comparison for a second, because it's absolutely stunning. While the rest of the housing industry was completely collapsing, USA Properties' portfolio was sitting at nearly 98% occupancy. While construction cranes all over the country just stopped, they kept building. And while their competitors were staring down bankruptcy, their financial model, built on that tax credit equity, not risky debt, kept them solid. The crisis actually increased the demand for what they provided.
And this quote from CEO Jeffrey Brown just says it all. During the worst of it, cities were desperate for any kind of economic activity. They were actually coming to USA Properties asking them to keep building because they were one of the only companies left standing that could. They weren't just surviving, they were a lifeline for these communities.
But getting through that crisis taught them something really profound. They saw the human toll up close. They had residents who were formerly middle class, people who had lost everything. And they realized their mission had to be bigger. Just providing 4 walls and a roof wasn't nearly enough. And that realization kicked off the next major chapter in their story, one that really cemented who they were and their purpose, which went way beyond just being a builder.
So the answer came in 2011. Taking all those hard lessons from the recession, the company decided to make its social mission official. They created a nonprofit arm and named it in honor of the founder, J.B. Brown.
It's called the J.B. Brown Fund, and it's built on these 4 pillars of support. It gives out scholarships for college and vocational training to help people build careers. It helps pay for youth sports to keep kids on a good path. And, maybe most critically, it offers emergency cash for that unexpected car repair or medical bill that could send a family spiraling. They partnered with a nonprofit called LifeSteps, and the company covers all the overhead, so 100% of every single dollar donated goes right to the residents.
And the impact has been huge. I mean, since they started it,
The J.B. Brown Fund has given out over $2 million in direct aid. That money is a vital safety net. It's the thing that stops one piece of bad luck from turning into a total catastrophe for thousands of families. So, having mastered the world of affordable housing and locking in their social mission, the company then looks around for the next big challenge, and that meant a major strategic pivot. What they saw was this growing problem in the housing market, something people now call the missing middle. We're talking about folks like teachers, nurses, first responders, the absolute backbone of a community. They make too much money to qualify for traditional affordable housing, but there's no way they can afford the rents in all these new luxury buildings. They were completely stuck. So the company pivoted. The big idea was that they could take their expertise in disciplined, efficient building and apply it to this new market. In 2015, they broke ground on The Landing, their first market-rate project in decades. Then they did ambitious urban projects like the AJ. This wasn't about ditching their mission, it was about expanding it to so-called workforce housing to serve that missing middle. And did it work? Well, this chart kind of says it all. The company saw this massive surge in development. According to Affordable Housing Finance magazine, they made a huge jump from being the 45th largest affordable developer in the country all the way up to number 15. And in California, they became number 1. But of course, just as they're hitting this incredible new stride, the world gets hit by another massive economic shock, the post-pandemic era. We're talking wild inflation, supply chains in chaos, and interest rates going through the roof. It was another trial by fire. And the pressure, believe me, was intense. Their interest costs on loans literally doubled. The collapse of Silicon Valley Bank threatened their entire funding model. But again, that strong foundation they'd built over decades held up. Their deep relationships with banks, their partnerships with state agencies like LIHTC, that's what let them weather the storm and keep their pipeline of projects growing.
So, after more than 40 years of being tested by fire, again and again, where does USA Properties Fund stand today? Let's just run through the numbers real quick. The scale is incredible. They've either built or have in the pipeline over 17,000 homes. And they do all this with a fully integrated team of over 400 employees, handling every single piece of the process themselves, from a patch of dirt to a vibrant community.
All this work is happening across a bigger and bigger map. They used to be focused just in California, but now they operate in 3 states. That includes Nevada and, most recently, Oregon, taking that battle-tested model to new places. Which, brings us to our final question. The story of this company, from starting out when interest rates were 18% to becoming a major market leader today, really forces us to ask, can a disciplined, mission-driven, for-profit company actually be a key part of the solution to a public housing crisis? Well, their 40-year history seems to suggest an answer that's definitely worth thinking about.